Maybe we have it all wrong. Maybe it's not.
Diversification.
Time in the market beats timing the market. When Ethereum can drop by 94%, should you really not time the market? When we can barely recognize the names of the top 100 cryptocurrencies just 5 years ago, should we really diversify? Maybe, just maybe, the learnings we got from the stock market don't apply to crypto, because crypto is different. Crypto is unregulated. Crypto is way more volatile. There has to be a way to at least partially avoid those 80% crashes as here just recently in Ethereum. I mean, how about simply using moving averages, right? That we bet on falling prices whenever the price is below, and we bet on rising prices whenever the price is above. And we simply switch according to where currently we are trending. But if we do this, should we take the 200-day moving average, or the 150-day, or the 100-day, or maybe even the 50-day? What would have worked the best in the past? And how well does that approach work over time? How consistent are the best moving averages? Statistics to the rescue. I have done backtests. I have done simulations of buying and selling Ethereum depending on moving average durations. And I've done this for the entire history of Ethereum. I've also done this for the last 3 years or so to see if there are any changes over time. Let's look at the entire history of Ethereum first. What we've got here on the x-axis is the duration of the moving average. So this goes all the way to the 200-day moving average. On the y-axis, we've got the annualized performance, and then we've backtested the simple moving average, that's here in turquoise, and the exponential moving average here in red. We can see what duration works the best. And over the entire history of Ethereum, so the data set here starts on the 7th of August 2015, we would have gotten, by buying and holding, 110% per annum. But by trading, according to the 23-day moving average, we would have gotten 230% per annum. So over time, that looks like this. In white, we see the Ethereum price. In turquoise, we see the back-tested performance. It's a linear scale, so we can't see a lot here in the beginning. So here we've got the same chart on a logarithmic scale. So the outperformance really happens by shorting Ethereum whenever we are below the best moving average. We do have trading fees in here, so 0.2% trading fees for changing positions every time. This looks very nice, right? And because this is a logarithmic scale, 10x's from one to the next horizontal line, this is a real delta, right? On a linear scale, this looks huge. But here's the problem, right? Just in the recent past, this has crashed a lot as well. It didn't really work that well in the recent past, this 23-day simple moving average. And so I split up that data. Maybe the way Ethereum behaved in the early days isn't the exact same as it's behaving right now. So here's the second data set where we start on the 30th of August 2019. So 4 years of data. Buying and holding again would have given us pretty much the same, 113% per annum. But look at here how the best moving averages are very, very different. The 23-day isn't good at all. We still would have made money, but less than buying and holding. And the only moving averages that outperformed were here, the longer duration moving averages. And they were all exponential. The best being the 155-day. That's the performance on a linear scale over time, and here the same chart on a logarithmic scale. So again, the outperformance mainly happened due to avoiding the crash and being short when Ethereum goes down. Now, this isn't too encouraging, right? The best moving average changed here quite a lot. That's something that we don't see for a lot of crypto assets. For Bitcoin, for example, the 40-day mark seems to be pretty good, and the 120-day mark roughly seems to be pretty good across different time windows. For Ethereum, it looks like the dynamics have changed quite a bit over time. Let's have a look again at the total time frame. How good is the 150-day EMA or SMA if we look at all of the data? Again, we see the chart. It's not that bad, right? It pretty much traded with buying and holding. There's a bit of outperformance around the 165-day SMA. So really it looks like these short-term moving averages, they only worked when Ethereum was still very small and volatile. as Ethereum matures, you have to take longer moving average durations. So let's look at this. Let's look at, say, the 155-day exponential moving average. The one that's somewhat okay for the entire duration and that's really outperformed in the recent past. Here we go. This is Ethereum with the 155-day. And look at this. We are very, very close to crossing this actually. It's currently at $1,732 and the behavior in the next day or two might dictate where we continue to go. There are some fake outs here, right? This is no perfect indicator. Sometimes in a fake out like this, we might be selling low and buying back in high again. But according to the backtest, this is the best that we have. If we do try to time the market and we do decide to take moving averages, we should look at something like this, 155-day EMA. That seems to be the pace at which Ethereum is currently moving at. This seems to be at how quickly momentum is shifting, which of course in the early days was way, way faster. People were way more speculative. Now there's more capital allocators into Ethereum. It's not traded that actively anymore. Let's all try to avoid those 90% drops and discuss the current market in Telegram. Link is down below.